Welcome to another episode of BHP Book Club. I am your host, Kelly Morgan. Today I'm speaking with Susan Laubach as we talk about her book, Rumpelstiltskin's Rules for Making Your Farthings Grow. Now, the funny thing about this book is it is a nonfiction investment book, but Susan's put a different spin on it. She gives all of the information in the format of fairy tales. So not only are you entertained, you're also learning at the same time. I think it's a wonderful concept. I can't wait for you to meet her, so let's just get right to it. Welcome to the book club and welcome to our podcast, Author Susan Laubach. Susan, thank you so much for being a part of the book club and coming on the podcast. Welcome.
Thank you. It's just a joy to be here.
Well, I am glad you're here to talk about your book, Rumpelstiltskin's Rules for Making Your Farthings Grow. I know it's a book on investing, and I want to learn more about it. But before we go down that road, I'm always interested in authors and how they decided to actually write and print that book. So is this your first book? Is this your first book out the gate? You're already a seasoned author?
Well, yes, in a sense, but I've only written this investment book. I did write one other, but it was written many years ago. And the other books I have written, first of all, some were for my children, and they were children's books. They were published by major publishing houses, but I wrote them when the kids were little. And then I wrote a travel book when we were traveling all the time. And I've been in the investment business for many years and just decided, well, actually, it started at the beginning of COVID. I thought, there's a way to talk about investing that doesn't have to be boring, could even bring a smile or two and maybe be more memorable if I put it in a storybook.
Yeah, I would agree. I mean, investing is important, but it has like this boring connotation with it, right? It's like you just don't. Somebody's going to drone on and on and on, and
they do,
and give you terms that you don't understand. So, you decided to write this book to help and inform others. Is that a good assumption?
Yes, that's a good assumption. And I have taught. I've been in business for many years, so I've taught while I was in the business as an active broker, people from, I think the youngest was 18, but the oldest was, I never even wanted to ask, pretty old. And all along, these people had a mild interest and had invested through managers and other people, but never had a real feeling of how to do it themselves. So I thought, I'm going to find a way to get that story out to them. I'm going to find a way to make it fun. So
yeah, I would agree. I always thought that the stock market and investing and finance should have been something that was really pushed and taught in high school.
And taught through stories, Kelly.
Mm-hmm. I agree. So tell me about your book. I know that you say that there's six things that we should know, but I'm interested in how you put this together as a story book.
Well, because there are lots of books that are like lecture books that talk about what to do after you're in the market, how to figure this out and that out. But I want people to be armed before they get into the market, or if they're not confident in what they're doing, to have sort of a basic level of confidence that they kind of feel armed. And these 6, I call them rules. They're really things that I want people to know. I decided that each rule could be embedded in your head by putting them in the middle of a fairy tale that lends itself to the particular rule. And that's what I did.
So are there 6 fairy tales in the book?
Yes.
So have you made up the fairy tales, or did you take a spin on an old fairy tale?
Yeah, no, these are all old. And actually, the turtle and the hare, from which the first rule comes, is an Aesop's fable. It was the turtle and the hare. Everybody knows that. Although I must say, Kelly, not everybody knows these fairy tales that I grew up with. I don't think are totally familiar to today's little children. So I put together some material for teachers too, using the book as a background, and counseled them to have the kids all read the fairy tales first. And the Goldilocks and Three Bears story starts the book out by telling kids and people and adults how a company goes public. I think everybody should know that. Then we have the turtle and the hare, and then we have the three pigs, and then we have the Sleeping Beauty, and then we have the Emperor's New Clothes, and then we end up with Rumpelstiltskin's own story.
I like how you did that as fairy tales, because you're right, it's more entertaining. So not only am I learning something, right, that I can apply, I'm also entertained as well, so I'm not bored to death.
I hope so. Yes, I hope so.
Go ahead.
That was the reasoning, behind it. You want people to keep on reading it. You don't want them to fall asleep and say, "Oh, this was silly. Why am I wasting time on this?" I want people to want to continue reading and see how did these, how do we get a rule out of this particular fairy tale? Well, that's interesting.
Right. And I can see too how some of the fairy tales may apply, like the tortoise and the hare. They always say slow and steady wins the race, right? And I think when people think about investment, or when we hear about investment or those who invest, they're making large amount of money, or it seems like they're making large amount of money very quickly.
Seems like, but, and in these times, where there's irrational exuberance, not everybody is going to make all that money. The other thing is that the prices of certain stocks are so high that people don't want to get involved. They don't want to go in. They figure, the market's up so high, I can't go in now. But that's not true. You can always get started. Start small, start slow, and keep on going.
So let's talk about stocks for a minute. And I don't really know a lot about stocks and bonds. I think I've maybe purchased one a long time ago in a finance class I took when I was in college, because it was part of our assignment. But I've always had an interest in stocks, not really understanding them, and not really understanding like the NASDAQ and the other exchange. Does your book go into anything like that, like what the exchanges are or what they mean or anything? No?
That'll be the next book. But this particular book will get you to that phase. In other words, this is the very beginning. You read this, you sort of absorb these rules, and you say, okay, now I'm ready to go forward. And by the way, the NASDAQ is what we call the over-the-counter market, National Association of Security Dealers, quote, AQ is for quote. And then there's the New York Stock Exchange, the American Stock Exchange, and then the foreign stock exchanges. All very confusing, nothing you have to know about at all. You don't need to know how those work. You really don't. You only need to know how the company you invest in works, or the mutual fund, or I prefer exchange traded funds, or ETFs, which you may have heard of. I prefer those particular things. And as I say, the background, how they're doing their business on the floor and all that stuff, you don't need to know that. That's just confusing. Yeah.
And so what does your book, does it get us ready or talk about penny stocks? Or is that in the second book as well?
Not at all, because I don't believe in them. They're not, in my opinion, they're really, well, I can't use the word, but they're crappy things. And that's not investing. That's, you might as well, take your money out to the racetrack. I think you do just as well, maybe even better. Penny stocks don't belong in the world that I am suggesting you get involved in, or the readers get involved in.
See, and that's good to know, because these are just the terms that, as a layman, terms that I hear that I really don't know anything about, right? So I'm thinking it's all kind of the same thing. And it's sounding like it's not. And
no, it isn't.
And then it sounds like your book is telling me kind of what I need to know. Like you said, I don't need to worry about what's going on. I only need to worry about this, and that makes investing, it makes it a little less intimidating.
And it shouldn't be intimidating. It should be something that you feel comfortable doing. And frankly, Kelly, the best way for a person to feel comfortable is to get started and keep going. And maybe you get started by buying 10 shares of a company that you have seen in action and approve of the values of that company. And you want to own it, because even with 10 shares, you are an owner of that company. And so you want to make sure that you approve of what they do. The other choice you could make is to buy an ETF that I referred to a moment ago, exchange traded fund. There are many, 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 and I have loved these since they first came out, which was a long time ago. I'm going to say, gosh, it's almost 30 years ago now. But exchange traded funds are baskets of securities, of stocks in the same kind of either industry or region or something that might have piqued your interest. Pharmaceuticals, healthcare. There's so many that I couldn't even begin to name them. But the exchange traded fund will hold those securities in that basket, and you can buy that basket. You can buy shares, 100, let's say, 50. And the advantage is that there's no management fee. Mutual funds have a management fee. No management fee, because they don't manage it. They just stick it into the basket. You can buy it in what we call real time, which means you can buy it all day long. Mutual funds, you have to buy at the end of the day. You have to take the price of that fund at the close of the market. You don't have to worry about that with ETFs. You can buy it at 10 o'clock in the morning, 11 o'clock, whatever time of day you call your broker or you make the decision to buy it. And that's a big plus the fact that there's no management fee.
Wow. So does your book get us ready for things like that?
Yes, but I don't discuss ETFs or anything like that. I just get you ready with some rules that you should process and then follow.
So I don't want you to give us all the rules, because obviously we want people to go get the book, but give me like what you would say would be your top 2 rules.
Okay. Well, I've certainly already mentioned get started and keep going. Another one that I've always felt was so important. Always ask what can go wrong. Now, that doesn't mean that you don't buy it if you know what can go wrong. It just means that you're prepared. And if you're prepared for the fact that this company might be affected by interest rate changes, by something that happens in the international market, by regulatory things coming out of Washington, as long as you know that, and you know that this company is strong enough to weather that storm, you go ahead and buy it anyway. It's just that you're prepared to get into something when you know what can go wrong. So that's the second thing that I think they're all important. But the last one I think is really important. Don't expect more from your investment portfolio than is reasonable. For example, if you have a nice diversified portfolio, which when you start, of course you don't. You have your one stock that you bought or your one ETF and you're building your portfolio. But you hear other people say, oh, I doubled my money. No, I tripled my money. And you think, well, I didn't triple my money. What happened? Don't expect to triple your money or quadruple. Don't expect that. If you can, and this may sound really strange in these palmy times, but if you can get 7 to 10% from your portfolio after tax, year in and year out, you're going to be very rich. And the thing to remember is that may mean that some years you will make 20%. Don't count on it.
Right.
Other years you may make 2%. But if you get a steady average growth of 7% to 10% is really optimistic. But if you can get that year after year after year, you know, these pension funds, if they make 5%, because they're very conservative, they're conservatively, one hopes, invested. And that's considered successful. You're a successful investor if you can do that. So don't expect to, particularly if you buy something because, and I talk about this in the Sleeping Beauty part, if you buy something because a bond, if you loan money to an entity and get interest payments while that entity holds your money, that is a bond. And you do that because you absolutely must have that money back at a certain time in the future. You can't risk it in the stock market. So when you buy that bond, or when you buy a security like a real estate investment trust, let's say, or something, a utility, something that you buy only for the income. That's the only reason. You don't expect growth. Don't expect the market price to go soaring. It's not going to. You bought it for the income. And don't ask that poor little security to do more than you bought it for. On the other hand, if you buy a stock because you liked its growth in earnings, don't expect it to pay you a dividend. Don't expect it to send you money 4 times a year. That's not what you bought it for. So you got to keep in mind why you bought it, and then you manage your expectations and keep them reasonable.
So how long is buying stocks a long game? Do you buy stocks to keep them for a long period of time?
In my opinion, if you buy them having followed the rules, you haven't paid too much for them, you bought them for the right reasons, you found that their earnings growth was steady, that as long as those things hold true, you hold on to the stock. Somebody said to me the other day, well, I've made so much money in this particular company. Do you think I ought to sell it? And my advice under those circumstances would be, if you're just itching to sell it or you need money, get your original investment out. Sell as much as makes you back the money you put in. And let the other ride along, let the other continue to grow, so that you're still participating in the growth of that company. Otherwise, don't do anything. Just hold on. But remember, you have to know the reasons why you bought the stock. You do want to know the reasons why you bought the stock.
Right. I think most people think they buy stock obviously to make money, because that's what you see on TV and in movies, right? People buy stock, they make money. I never understood how you could make money off of a stock unless you sell it.
Unless you sell it. And this is quite true. You really don't. It builds for you, so that it builds toward your retirement or toward your buying a house or whatever it is. And you can do something else with that money. You can borrow against it. You can borrow against your stock portfolio and pay a very low rate of interest in order to have the cash to buy your house or to put your kid through college or to retire. But the general feeling with a good growth stock portfolio is that you are investing. You're not trading. You are investing. You are committed. And to hold it as long as the reasons you bought it hold true. What might those reasons be? Well, the earnings growth is steady, let's say. The management is proven. The product is proven. It's not a new company. It's a proven company with a track record. So it's just, if you're buying an individual stock, it's a really good idea to write those reasons down so that you don't lose your head and sell in a panic if the market is crashing and you say, I gotta sell everything. No, you don't. Never sell in a panic. Just look at those reasons and say, is anything changed? My management's still there. Earnings are still there. Product is still good. I'm not going to sell.
Right. So when do you anticipate the second book becoming available?
Oh, I haven't written it yet.
Oh, okay. Well, because you had mentioned the second book, so I'm thinking, well, let's get that second book out there.
That one out, yeah.
So is it still something that you're thinking about?
It's in my head, yes, and I'm trying to think of a vehicle. It may be more fairy tales, but I'm trying to think of a vehicle to get us into explaining the markets and ETFs and the things you and I just talked about.
Right, because there's so much information out there. Right. And now I always see these companies where you can just trade yourself, right? E-Trade and all these things.
Well, that's not bad because the trading part is bad. Don't do it. That's not investing. That's playing. That's playing the stock market. But it's not investing. But the ones that don't charge you any fee for getting in. They don't charge you anything like that. I think E-Trade may be one of them. Mm-hmm. And Schwab, and I shouldn't be mentioning names, but where you find that you can do your purchasing for very, very little money, that's a good thing.
Right. But I'm just saying that now it seems like there's just so much more information available. Yes. Than when I was going to school and even when I was in college. There's so much more information that it can be.
A lot of information, yes, but not much knowledge. In other words, there's all sorts of stuff out there, but it's very hard for you to make a determination about the quality of the things that you're reading.
Yes. And that's what I was saying. There's so much information that it can be overwhelming, especially if you really don't know what it is that you're looking for.
That's
right. So when you're a novice, it's not, that's why I really like the idea of your book and you putting it into fairy tales, because it makes it easy to understand and it gets us ready for your second book. That's right. And there are things that I do want to put in the second book, which is the way in which you write down, or the fact that you write down why you bought something. I'll get, probably as specific as I can get without running afoul of the regulatory environment. You can't do a whole lot without bumping into the SEC and rules. So I have to be circumspect about that. But I can certainly explain to your listeners how much you need to know. And actually, when the bottom line, how little you need to know, except about the company or the ETF that you are buying, or and
the
like
bond.
I said, and that takes, I think, the pressure off.
Absolutely.
I think that's why a lot of people don't invest. And people feel like I don't have the money to invest, right? I have to put food on the table. I have bills to pay. I don't have any money to invest.
Well, now that's another good point that you make, because you only want to use your discretionary income. You don't want, and you might say, I don't have any. Well, you know what? You probably do. If you have something that you ordinarily would go out for dinner on a Saturday night and spend, what, $50 or something, you can save that for a few nights, a few weekends, and you'll have money to go into an ETF. You'll be able to get started. And I think that's another thing to consider, is getting started on a very small scale and follow that. You know, at one point a little while ago, my grandson was very interested in certain technology products, let's say, I won't go into the names, and I was able to buy him 10 shares very reasonably. And now he's all excited. He owns it. Right. And he notices whenever anybody mentions this, he notices, and he perks up. As he gets older, he's going to want to read the annual reports. And he's going to be enthusiastic about this. And that's the way to get started. You don't have to be rich. You'll get rich, but you don't have to be rich to get started.
Yeah, I agree. And that makes it less intimidating. So yeah. I'm so glad that you wrote the book, Susan. Tell us the name of the book again.
It's Rumpelstiltskin's Rules for Making Your Farthings Grow.
And where is it available?
Amazon, Kindle, and I recorded it for Audible.
So it's available on audio as well?
Yes.
Fantastic. Susan, thank you so much for coming on the podcast and sharing with us. I can't wait for the second book. So when you get that second book out of your mind and on paper, you definitely come back and you will share with us.
Thank you, Kelly. I always enjoy talking to you. You're a lot of fun.
Thank you. Thank you for listening to another episode of BHP Book Club. I have been your host, Kelly Morgan. I just wrapped up with author Susan Laubach as we talked about her book, Rumpelstiltskin's Rules for Making Your Farthings Grow. It is an investment book, all done in the format of fairy tales. It is available on Amazon, and Susan's even created an audiobook. If you are an author and you are interested in promoting your book on the podcast and being a member of the book club, it is simple. Just go to my website, brightheadedpublishing.com, go to the contact section, drop me a note, we'll connect. Next thing you know, you're on the podcast. It is truly, truly that simple. All genres are welcomed, and most importantly, there is no cost or charge for you to be a member of the book club. So next week, I will bring you another author and another story. I thank you so much for listening. I truly appreciate everyone who listens. I really do. But until next time, keep writing.